Volatility retreating in today's session with the VIX hitting its lowest level in over a week. But our next guest says big moves in other asset classes could signal more market gyrations ahead. Mandy Xu is CBOE's head of derivatives market intelligence, somebody who knows all about the inner workings of how these things tell us or are tea leaves for the future. So tell us, is the volatility regime going to continue?
I would say yes. And that's because even though the VIX has fallen pretty significantly over the past week, we're seeing volatility in other asset classes actually increase. And that divergence is pretty unusual.
Like where, by the way?
Commodities, oil, gold, currencies, and the most notable one is fixed income bonds. So our VIX TLT indicator, which measures volatility in the bond market, that went up 60 points last week. It's retraced a little bit today, but it's still near multi-year highs.
And how often, what does that signal? How often do we see moves of that variety in underlying volatility for something like a long bond ETF?
It's very unusual. So last time we had this big of a move was back in 2022, which, if you recall, was when the Fed was aggressively raising rates. What's interesting, actually, in the bond market right now is if you look at options positioning, people have really flipped their positioning. So for most of this past couple weeks, people were positioning for yields to go lower positioning for potential recession. But over the past week, that completely switched. And now what we're seeing is actually more demand for puts in TLT, positioning for yields to go higher. And I think that's significant because, as we know, typically Treasuries is a safe haven asset. And we've seen over the past week, falling Treasury prices plus weaker dollar, that really indicates an erosion of confidence in the U.S. markets right now.
So you're saying that the volatility in these other asset classes is likely to induce additional volatility in the equity markets?
Could spill over, certainly, but I think it indicates that the macro outlook is a lot more uncertain going forward than maybe what is priced into the equity market right now.
If you look at the way things are shaping up then, is the protection that you would buy for possible downside volatility relatively cheap in your mind, or is it still elevated? It's elevated compared to what it was 2 years ago.
Correct, yeah.
But not compared to what it was 2 weeks ago.
So overall, volatility levels are down. So if you're talking about the premium they're spending for protection, whether it's in the equity market or others, that's certainly lower compared to the high a week ago, but it's certainly not low. And what we've actually seen in the equity market over the past week is even as markets have rebounded, we're seeing that demand for protection still continue in the equity options market as well.
So, Mandy, this volatility period's lasted now more than a month. How long do these typically last? This could go on for, I think, longer than people realize.
I think so, too. I think it really depends, again, on the underlying economic condition. When we go through a recession, you could be in a prolonged period of elevated volatility. I think in the past decade or so, certainly people have gotten used to really quick VIX spikes and then very fast retracements. Those tend to be more technical moves, like what we saw last August. When it's fundamentally driven, then you could be in a prolonged period of elevated volatility.